Hey everybody, welcome. My name is Matthew. Thank you very much for joining. Today, we're going to continue our discussion on Bitcoin ordinals, Bitcoin as base money, and Bitcoin transaction fees. All right, so here we have again the daily average transaction fee per transaction in US dollar terms for the Bitcoin network. If you want to hear more about why these things don't compare to Visa, Amex, PayPal, Venmo, FinTech, anything on your phone, app, modern fiduciary media, check out yesterday's video. Check out a lot of my prior videos for more on that. But here we're going to talk a little bit more about what these transaction fees actually mean in the context of the Bitcoin network, since Bitcoin is base money. One little quick update. Okay, let's look to the latest data. As I said, I'm collecting data that is sometimes one, but mostly a 2-day lag. So yesterday I showed you transaction fees ending May 7th. The daily average rate per transaction, the average Bitcoin fee was $19.75. I told you they were growing. They have been growing. Let's look at the 8th. $10 higher. Let me stop the mouse there. $30.36 is the average transaction fee in US dollar terms across all of the transactions, 600,000 or so transactions on the Bitcoin network on May 8th. Now, it does seem in the last couple days, May 9th and May 10th, the date of this recording, that these transaction fees may level off, may even cool off, go down a little bit, but we'll see. No one knows what's going to happen next week. Inscribing JPEGs with a signature and putting that on the Bitcoin blockchain is all the hype at the moment, so no one knows what will happen. But again, is that the primary function of the Bitcoin blockchain? It is certainly not. Is it a use case that might take off on the Bitcoin blockchain? Maybe. And again, if it does, that's kind of interesting. It's kind of funny, frankly, that the Bitcoin blockchain is doing a runaround over all these other blockchains, which apparently were more special purpose or a better fit for these types of use cases than Bitcoin itself. So that's just kind of funny. Anyway, Bitcoin is base money. That's the point. Let's reset the zoom. Okay, we have these two peaks, which were the main clusters of transaction fee spikes in Bitcoin's lifetime, and this is the third. All right, we're in the midst of the third right now with Bitcoin ordinals. How does that actually compare with what is happening on the chain generally over the course of Bitcoin's lifetime? For that, I contend, dear viewer, dear listener, if you're listening, you really need to look at things in terms of TTM. What is TTM? Trailing 12 months. Okay, so here we can definitely, if you look at things on a daily frequency, you can definitely see the spikes. You can see them much more. And again, this is US dollar terms. We're not looking at data rates or Satoshis per virtual byte. But these are helpful, certainly, to see, what's happening on the moment, on the day, how things are changing. But I really encourage you, even if you're not looking at Bitcoin stuff or blockchain stuff, if you're just looking at stuff for trading or in the stock world or the bond world or the financial world or the economic world, it's really, really helpful to look at things in a trailing 12-month basis. Yes, you can annualize something, that is, take the daily rate and multiply it by 365, but that might not always help, right? Because you might be catching an off day or a day with a spike that's unusually high or a day that's unusually low. So multiplying by 365 is not necessarily helpful. What's more helpful is to say, look over the past 365 days over any period and just roll that continuously over 365 days, or trailing 12 months. That's the financial term, because usually financial data is only posted for companies and stocks and whatnot on a monthly basis or a quarterly basis. But here, of course, with Bitcoin, we can do it all on a daily basis, or even more. We can do it on a block basis if we wanted. Nonetheless, let's keep it for the regular calendar denomination for now. Roll it. Look at it on a 365-day trailing basis, a 12-month trailing basis. That's TTM, okay? So what I want to do now is let's understand that miners, when they service the Bitcoin network, when they include transactions into blocks, which is what everybody wants to do. That's why you use Bitcoin, is to get transactions into blocks. They earn two things for providing this service. The first is transaction fees, which you see here on a daily basis, on a per transaction basis. And the second thing is they earn what's called a block reward, or the issuance of new coins, of new Bitcoins. And as you see here, I have the halvings. We started out with 50 Bitcoins per block, 7,200 Bitcoins per day. Having one we've been through, we cut it down to 25 Bitcoins per block. Having two here, 2016, we cut it down to 12.5 Bitcoins per block, and we've been through three halvings already. We're now at a 6.25 Bitcoin per block epoch. The next halving is going to happen about a year from now, where we will go to 3.125 Bitcoins per block. So those Bitcoins go to whichever miner wins the next block, finds the nonce, and creates the next block to extend the Bitcoin blockchain. That's how it works. So just again, laying a few ground rules there for what I'm going to show you. Let's now compare this again to just sort of understand a longer term aspect of what's happening with Bitcoin as base money here. Let's look at this stuff on a trailing 12-month basis. Now, fees, that's one component. But everybody probably knows with Bitcoin that fees are the vast minority of miner revenue so far. Most of the time, miner revenue is the block reward. You might have seen, if you've been on Twitter or following some Bitcoin websites over the last couple days, there has been a block, at least one. I'm not sure if there has been more over recent days, where the fees actually were more than the block reward. So there was more than 6.25 Bitcoins collected in fees in the same block. All right, that's been pretty rare. It has happened a few times before, all right, in these periods, but it's pretty rare. And now it's starting to happen with Ordinals. That's just one block at any time. To really get a broader perspective, let's look at over, many days, many weeks, many months, many years. Okay, so now what I want to show you is, let's look at the trailing 12-month issuance or percentage that the Bitcoin block reward makes up of miner revenue. And it's going to be US dollar terms. It's going to be on the right axis. It's going to be a percentage. We'll put that now. All right. So as this is trailing 12 months and it's in dollar terms, and I start my data on Bitcoin Pizza Day, which is May 22nd, 2010, this line starts on May 22nd, 2011, because it's one full year after I have some US dollar data to apply to the Bitcoin fees. Okay, so at this point, the daily fees are, a few cents, 2, 3, 4 cents in 2011. But I'm collecting the 2010 fees, which are even sub 1 penny fees. And I'm collecting them all up over a 365-day period, over a full year period. And that is going to be that proportion of the block reward. And as we know, fees are a very, very small component. The vast majority of the miner revenue at this time, for sure, 50 Bitcoins a block, was in Bitcoin terms. And even when Bitcoin is valued at a low, low value, I'm not showing price here, but in 2011, we were, could have been under $30, could have been under $2. In 2011, depending on where you look at it, that's what this is showing here. 99% of the revenue for miners is from the block reward, not from fees, not from what you see on this chart. All right. And then, of course, we can see here the moment when we do have these spikes, this line falls. Fees become a greater proportion. But what this line allows us to do, this is why I'm a fan of TTM, is it allows us to really understand what's happening across the network, across time. Because, we can see that for a few days, fees were, let's zoom in here, a few days here in 2017 when Bitcoin was screaming to $20,000 per Bitcoin for the first time. Fees were pretty huge, $70, $60, $50 for a few days. But they fell down, and of course SegWit was activated just before this, and address usage and blockchain usage changed. Fees went back down. So how do we smooth that out? How do we understand that over time? Well, we look at this in a trailing 12-month and annual basis. So we can see that the most extreme was just after that, where we catch this period, 82%, right? 83%. It's much lower than it was. It was up to 90% here. But if we zoom in, we see that it goes all the way down to 82%. So what does that mean? That means 18% of the block, the total block revenue over a period of time, that is the prior year period of time, was 18% fees, 82% block reward. So that's how it works. And you can see here that it definitely lasts, right? We catch this big portion of fees, and we get down to 82%, but then as fees go down, the percentage of revenue that is from mining issuance goes back up. So it goes back up here, back up to 90% already by the end of 2018. And again, this is catching a year's worth of data. So the spike happened here in December of 2017. So by December of 2018, you really start to shoot back up because fees have been low for a year. And so this percentage starts to shoot back up. Even though you can see on a daily basis, yes, fees are down again. But this just shows you sort of a smoother, longer term, more economic type of a number where we can sort of compare, okay, how have miners been doing over the last year compared to, say, any other business? And I've definitely done this analysis on a gross level, on a dollar level, on a Bitcoin level in prior videos. I'll link to those in the show notes here. But, you know, this is just in percentage terms. You can see that we can start to see, okay, so something definitely was happening here. And it definitely changed the economics of mining for miners during this period. But it didn't change it too long. And, you know, it only took a year to basically get back all the way up above 95% again, all the way up above 98% again by 2019. Fell down a little bit here with some rise in fees, 96, 97% issuance proportion. And then you see the next spike, of course, 2021, it falls down again. Actually doesn't fall as low as it fell in 2018 on a trailing 12-month basis. Here, it only falls to about 88, 89%. Okay. And then we're back up. Once fees go back down, Taproot was activated again. I don't know how much of the savings in fees that users paid to miners is reflected here, because it usually takes a while for these new addresses, new wallets to come into effect, if there are any savings generated for users. But nonetheless, you do see that fees fall back down here. And again, the issuance component rises, the inflation or the new coins. Inflation isn't actually the best word that I should use for this. It's new coins or issuance that rises again to where we're above 98, 99%. And then just here, back to Bitcoin Ordinals here, we see it just starting to dip on a trailing 12-month basis, going down about 97.5% or so as of today on a trailing 12-month basis. Instead of being above 98% or close to 99%, as it was in basically all of the year 2022, we're just starting to go under 98%, 97.5%. Will probably be shortly, down to 96, 95%. But this is where it's going to be interesting to see if this is really changing the economics of Bitcoin, changing the way that miners are mining and the way that users are using the Bitcoin network. Because, yeah, we've seen it twice before, more drastic even here in 2017 and 2018, where a trailing 12-month basis fell down to 82%, being issuance, 18% fees. Here, 2021, only 88, 89%, 11, 12% in fees. Will this time be even softer? Meaning maybe it's only 5-6% fees after all this Ordinals business is over. I don't know, maybe. But again, this is where you have to start not necessarily worrying about fees and just look at what Bitcoin is. Bitcoin is base money. These transaction fees are way different, as I said in the last video, way different than PayPal, Venmo, any TradFi, fintech stuff. It's just different because we're moving base money here globally, digitally, amazingly. That's something that, you need to compare with gold or silver. A very helpful viewer who comments on some stuff on the videos asked, what is maybe some other base money fees like? And I should have said that in the last video. Depending on the company, depending on the time, you might pay 3 to 6%, even more than 6%, 7%, maybe 8% over spot for gold and silver, just for a regular transaction of gold and silver. Remember, gold and silver are base money. Doesn't matter if it's in jewelry form, doesn't matter if it's in coin or bar, or monetary form, in a bullion or in a coin form. It doesn't matter. That those metals have acted as base money throughout the past. And yeah, they have fees too. And they have storage costs as well. Bitcoin is much cheaper from those perspectives. When you talk about fiat-based money, the dollars, the euros, the yen in your pocket, those by law usually are forced to trade at par. No one's going to charge you to pay for your coffee with a dollar bill. That's just not how it works. And in fact, that by law, they don't want to allow you to do that. And this even has way deep historical roots, because actually banknotes used to trade at discounts depending on where you had them, how far you traveled from your home bank, from your home state, from your home city. Banknotes used to trade at discounts 100 years ago. Now, by law, banknotes are forced to trade at par. And so some people think that that's a good thing. But of course, if they want to trade banknotes for another banknote, you are going to have a fee, an FX fee, a foreign exchange rate fee. By the way, the price of money is the exchange rate. So you're going to have a fee there, even on the market. I think unless you go, I visited a friend in Jordan, the Arab Muslim world, they say they don't like to charge interest or fees on money. I'm not so familiar. I'd be happy in the comments if anyone can enlighten me there. But I remember visiting a friend in Jordan who was working for the U.S. government there, and they didn't have any exchange rate fees. But again, that's a legal tender forcing something to par, which is actually not good generally in economic terms, because you do want to see a fee, because things have a cost. Everything has a cost. And if someone's going to move from a more liquid currency to a less liquid one, there needs to be a spread there to understand how viable this currency is, if it's liquid, if it's not liquid, so on and so forth. But nonetheless, I'm digressing a little bit. But yeah, base money has a fee regardless. And that fee is way different than a credit card fee, than a debit card fee. You just have to understand that. That's base money. So gold, silver, fiat banknotes, and even fiat banknotes which are forced to be accepted at par at merchants, you're still going to have foreign exchange transaction fees. And once you put them into a bank anyway, you're going to have other fees from your bank. So there's no free lunch here. And, maybe I'm digressing a little bit too much on fees, more than I thought I would in this video, but hopefully this helps. These are the types of things that you need to be thinking about when you see fees on the Bitcoin network. This is just not credit card, debit card stuff. Not at all. Yeah, I didn't expect a use case of Ordinals to come on to base money Bitcoin. I didn't expect it. But again, I think it's funny that Bitcoin is perhaps doing the runaround of other chains that are supposed to be better for this stuff. We'll see. We'll see how much the market will bear for these fees. Like I said, they're already coming down in the last day or so. I'll keep an eye on this on a per day basis, and of course on a trailing 12-month basis. But as we can see here, as of right now, it's nothing new under the sun for Bitcoin miners. 99% of mining revenue on a trailing 12-month basis is that same old block reward, the new Bitcoins that come out of every block, 6.25 Bitcoins per block as of the last halving for the last 3 years or so. That's just how Bitcoin is working. And it also should be said, yes, this green line, it will definitely, over the next 100 years, at some point, go below 50%, where the value in US dollar terms and in native Bitcoin terms, which I'll show you in a second, is less. The new issuance, the new coins that come out every block that miners earn, that's going to be less than 50% of what users are freely paying on the market. When I say freely, I mean in a free market sense. Free as in speech, not as in beer. In a free market sense, what buyers and sellers, users of Bitcoin people that want their transactions included, yeah, fees will take up the majority, let's say, of mining revenue over on a block basis, on a daily basis, and on a trailing 12-month basis. That will happen. No one knows when that will happen. Then the last thing just to point out, very briefly as we close it here, let's look at this orange line. This is native Bitcoin terms, okay? So very, very close. You can see the green line, which is dollar terms over trailing 12 months. It's a little bit more exaggerated as the dollar price spikes more. So you can see that happens more here and a little bit more here in 2021. It's and more, I mean lower. The issuance is lower, the fees are higher as far as a proportion of total miner revenue, but generally it's the same trend. It's the same idea. Okay, if it's native, first we find native Bitcoins, right? So this goes all the way back to 2010. It's a trailing 12-month figure. It's 100% of mining revenue, right? For a long, long time. Generally, it's pretty close. Okay, it's pretty close. So yes, fees during this Ordinals episode hype of Bitcoin have at least once been greater than the issuance of new coins in one block. That's happened a few times before. Might happen again for a few times during this hype period. But I highly suspect that we're going to stay on the course that we've been for a while, and Ordinals won't be the thing to change this pattern. I could be wrong, of course, but I think usually the way that you're really going to see fees jump is a massive speculative adoption of Bitcoin. And then that's where you see fees jump. But, they typically go back to where they were before. So it's really just going to take more and more and more adoption for fees to rise on both an individual level, but also en masse from a total block proportion for miners, and for this percentage to eventually creep down to 50%, to where it will eventually cross, and fees will be more than the block issuance every 10 minutes and on a trailing 12-month basis. So remember, Bitcoin is base money. All this stuff is just a fee perspective from people using Bitcoin as base money. I understand this can be pretty painful for businesses that have a lot of flow, a lot of cash flow with Bitcoin, and really want that volume on chain for their users, for their customers. But at the end of the day, Bitcoin is base money. It's like gold, like silver. It's even like that dirty, regulated fiat paper banknote in your wallet. So that is what it is. That's what the fees are. This is the breakdown of the fees on a trailing 12-month basis. We'll keep an eye on this as this Ordinals hype cycle continues. Thanks for watching.